We're honored to have with us our dear brother Hood Williams, who I met this recently, mashallah, but he's a really good brother, mashallah, from the little time I've known him. And he's going to be doing a presentation about Amani mutual funds and investments. And as you see, investing according to Islamic principles. So he'll be speaking for 30 minutes, and there will be time for your Q&A, inshallah. And inshallah, after that, we have some peace, inshallah. So without further ado, our dear brother, Hood Williams.
Assalamu alaikum. I tend to move around a lot, so I'm make sure this microphone can catch me. Um, so alhamdulillah, let me introduce myself. Bismillahirrahmanirrahim. Allahumma salli ala sayyidina So I'm really, really delighted to be here. Thank you for hosting me. Thank you for hosting and coming to learn about Islamic investing. I promise to make it as short and as painless as possible, inshallah, okay? That is a low crowd. Okay. So I want to introduce myself. My name is Hood Williams, and I'm always delighted when I'm speaking to a group of Muslims because they know where my name is from. You know, when I'm talking to people of other faiths, they're always looking at me like, did he say hood? Like boys in the hood? Like neighborhood? Um, so I'm always delighted. And so Hood Williams, originally from Virginia, D.C. area, uh, graduated undergrad from Old Dominion University with a degree in economics. I moved, actually, after I graduated, I actually lived in Tampa for a little bit. I actually lived in Tampa for 6 months studying at a place close to the airport, and I used to come to the masjid on Sly often when I lived here. After undergrad, I actually worked in corporate America for PwC. Then I transitioned and got my MBA from Georgia Tech, and I lived in Atlanta for 15 years. So when people think about where I'm from, I'm really from the ATL. Last year, I actually moved to Dallas, and so I really enjoy living in Dallas, no surprise. I think a lot of Muslims are enjoying living in Dallas now. And I've been studying after undergrad. I actually went, after my MBA, I actually moved to Malaysia and studied Islamic finance at Kuala Lumpur for a year. But one of the things I like to talk about, there's two stories about why I do what I do and why I care about it. The first story is after undergrad, I went to George Mason University. There was this program for the MSA on Islamic finance. And I went there, and the sheikh who was speaking, he said insurance is haram, banking is haram, investing is haram, credit cards is haram. And then after the presentation, he gave his salams, he went to the airport, and he flew back to wherever country he was from. And I was just like, whoa, like, you just told me that everything I can do in terms of my financial life here is haram, but you're not even here. You're not even trying to make it work here, right? And so that just kind of never sat right with me. And so that what led me to go study Islamic finance in Malaysia. And the second story is after getting my MBA and after studying finance for a while, I sat down with an auntie of mine. This is a Muslim woman who took her Shahada in 1972. Right? Think about this. Think about, we see Islam now, but think about Islam. Think about Islam in Tampa in 1972. Right? This is before CARE. This is before masjids were on every corner. This is before the major Muslim organizations. And this woman took her Shahada. She donned on the hijab. Her family ostracized her. And she came to Islam. She got married. She had kids. Now it's time for the sister to retire. And so we were sitting down, and I said, well, she showed me what she had. She basically had $850 coming from Social Security. And so I said, Auntie, where's your 401k? Where's your 403b? Where's your investments? Where's your individual retirement account? And she said this to me. She said, I never invested in that because I thought it was haram. So here's this woman who is faithful to her faith to the point where she lost her friends, her family, everything she had, her self-identity, to come into Islam. And she's been Muslim and she's been striving for the last 50 years. And now she's going to retirement, and she's going to retirement in a very kind of vulnerable state because of her practice. And I understand that Allah is going to take care of his servants, no doubt. But there has to be a way where we can actually take care of our own future, right? Prepare for our own future, because we're all going to be here. And so that's really what drove me to kind of really figure out, how can we make Islamic finance work here in the US? And it's not perfect, but it's the best we have. So inshallah, I'm gonna get into the presentation. I don't want to get too khutbah-ish on a Tuesday afternoon. I know people didn't come here for a khutbah. So we're going to talk about some habits of successful investors. We're going to talk about investing for college, investing for retirement, what it means to be an Islamic investment company, and then we're going to open for question and answers. Is that okay? Alhamdulillah. Okay. So bismillah. So the first thing is, when you talk about investing, one of the things that we have to note is that investing requires risk. That's basically one of the things that makes it permissible. So that risk can also include the loss of capital. So that's a disclosure we have to state. So when we're talking about habits of successful investors, I'm just going to cover three. I'm not going to drain the slide. That first habit is invest for the long term. We're going to see some illustrations that tell you about the power of compounding, right? And oftentimes people think about compounding interest, but it's really just compounding your investment, compounding your return. Number two, that you have to distinguish between a good investment and a good company. So it might be a good company, but is it really a good investment for where you are now, for the price that they're charging for you? And also understand emotional bias. If your friend runs up to you and said, hey, Brother Muhammad, I just invested in company XYZ, I got a 30% return. And so there's a thing called FOMO. Who knows what FOMO is? Who said it right here? Fear of missing out. So be like, oh, you had a 30% return? Oh, I want to put my money in it, right? So if he had a 30% return, what's the likelihood there's going to be another 30% return right behind that? Maybe, maybe not. But that emotional bias, you can't make investment decisions off of that. And so when you think about why people save for buying a home, for going to Hajj, the price of Hajj keeps going up. So in order to go to Hajj, you might not just be able to write a check. You might have to save and invest for that. What happens if you invest for Hajj? Let's say the price of Hajj in 2 years is $10,000. So you invest $5,000 this year and $5,000 next year. Guess what? Anybody have heard this word called inflation? Right? Does that affect Hajj? Yeah. So who's been to Hajj here? What year did you go to Hajj, Aki? 87. How much Hajj cost in 87? $2,000. Who went to Hajj in the last 2 years? Anybody went to Hajj in the last 2 years? In the last 2 years, I think that there was a Hajj package last year for like $18,000 for one person. So you can imagine kind of inflation. So if you just save, you might not be saving above the inflation rate. So you need to make sure that your savings are working for you. And so we're also going to talk about investing for college education. Education is one of the ways to the middle class in the U.S. And one of the things when people talk about the strength of the U.S. economy, one of the big reasons for that is the size of its middle class. It has the second largest middle class in the world outside of China, right? And this is one of the things that really moves it forward. And education is a part of what allows easy access into that middle class. And then we're going to talk about retirement. Retirement is very important. I can't stress enough. Like, how many people are younger than 25 in here? One, two, we got a couple of people. People are younger than 25, they're like, I'm not going to really retire. I probably will retire when I'm 35. It's people who are like my age who are above 40 who be like, I should have saved for retirement. Right. And so, mark my words, retirement is so important. Like, nobody in the U.S. wants to work forever. Like, the U.S. and Japan are the two major economies where the people work the hardest. And then there's this saying in Japan, I'm not sure the name of it, but people actually have worked themselves to death. They actually worked so they just drop dead. And so, the idea of retirement, even though it's long off, is something that we really have to think about. And the earlier you start thinking about it, the better your retirement will be able to be. And then health savings also, as we age, we're going to, the percentage of our income we're going to spend on healthcare is always going to increase. So investing for college, no surprise that the cost of college is going up. You can see that almost doubled in the last 20 years from 1992 to 2022, in the last 30 years, from 19,000 for a private school to almost 40,000. And you can see in this chart that the average amount of debt that a student graduates into almost with $30,000 of debt. So you're coming into the workforce already behind $30,000. And so we're going to talk about a way how you can chip off of that. And so this is a brief illustration about investments. And so by the time when your child is born, right, at 1, if you said, hey, I'm going to invest my Starbucks coffee into my child's education, right? How many people drink a coffee? Be honest. A fancy cup of coffee every now and then. Okay. So that's $5 a day, $25 a week, $100 a month, right? If you put that into your account for your son or daughter for college is around $1,000 a year. So this illustration shows if someone saves $1,000 a year for their child, right? So at the age of 18, they're going to have $34,000. And this is based off a 7% rate of return. How much did they invest? How much capital did they put in? $1,000 a year up to 18. It's not hard math. $18,000 exactly. And it's going to be worth $34,000. Like, that's one of the powers of investing. So when you think about investing, there's a couple of different options. The one option is the educational savings account. This is the account that we offer. You can open this account with an initial investment, a very small initial investment. Let someone see if they know the initial investment amount. What did you expect? How much can you open ESA with? Initial investment of $50. Okay, it's a little above that. Initial investment is $100. So you start with $100. The max you can put in is $2,000 a year. So you can contribute up to $2,000 a year. This must be distributed by the time your child reaches 30, or it could be transferred to another relative. And there's also an income limitation on this. So if you make above $220,000, you're not able to open a ESA account. And so these accounts are very flexible, very easy to open, and you have a multitude of investment options. So you can invest in halal ETFs, halal mutual funds, you can invest in individual stocks, so on and so forth. Another alternative to an ESA is a 529 plan. These are state-sponsored plans, and these plans are great because it allows you to put in more funds. So you can put up towards $16,000 into a 529 plan. Also, there's no salary limitation, so regardless of what your salary, you can contribute to a 529 plan. The one drawback of a 529 is that you have very limited investment options. And so you usually have these state-sponsored plans where they are going to mix equities or stocks with bonds. And bonds, because they're loans to corporation and government, they're not permissible. So that's the kind of drawback. There's very few halal choices when you're looking at a 529. The other account is a UGMA account. This is a Uniform Gift Minors account. So it's a joint account between a minor and their guardian. And this account allows you to put up to $16,000 per person per year. And this is not tax deferred. So the ESA and the 529 grows tax free. And when you use it, you're able to, you're not going to have to pay taxes on it if you use it for education. The UGMA is more open. It's a general account, so you can use it for a variety of things. You can use it for Hajj. You can use it for buying a car, for paying for a wedding. But it's not going to grow tax-free. Okay, so now we're going to move on to talk about retirement. We're going to kind of pretty quickly because I want to make sure we have enough time for Q&A. So retirement is great because, you know, there's different ways to fund education. Like you can get a scholarship, you can work your way. The honest truth is there's no other way to fund your retirement unless you put the money away. And some people often say, well, you know, well, my kids will take care of me. Alhamdulillah, definitely. You know, your kids are definitely going to be there, especially the investment that we put in the children. But what if the children didn't have to worry about you financially? What if they just worry about your health, take you to the doctors, but you already had your own income so that they don't have to worry about you? Folks my age, when you're 40, you're actually doing, you're taking care of your younger children. I have 6, right? And then you're also worried about your parents. So by saving for your retirement, you're actually also benefiting your children because you're not going to pass on the burden of your financial situation to them. So don't just think about it. You're doing something for yourself. You're also going to benefit your children. So when we talk about retirement, there's a couple of sources of income in retirement. There are personal savings and investing. This is basically what you put away for yourself and your family. There's pension plans. And if you have a pension plan, does anybody in here have a pension? Alhamdulillah. You know, they're not being offered anymore. So if you have a pension, you know, consider yourself lucky. Social Security. What do you think is the average Social Security check in 2020, 2021? Less than 1,000. Anybody else? 2,000. Okay. It's 1669. Okay. Okay. I'm not giving that back. Okay. I'm gonna take it. Well, what can you get for 1669 in Tampa? Can you get a 3-bedroom? Can you get a 2-bedroom in a neighborhood you want to live in? Okay, so imagine if 1669 is everything you had to, your rent had to come from there, your food had to come from there, your travel had to come from there. It's not going to cut it. So there's also employment during retirement. Okay. Well, I'd much rather people work because they want to versus working because they have to. So when we're talking about retirement, I want to go over 2 brief illustrations to show the power of compounding. This first illustration is someone who invests $1,000 a year from the age of 25 to the age of 35, right? That person is going to have, at the age of 65, they're going to have $112,000, right? $1,000 a year from 25 to 35. And at 65, that $10,000 they put in will be worth $112,000. Okay. That's our sisters. That's what our sisters would do. Our brothers, they're playing catch up. Let's say they're going to invest $1,000 a year from the age of 35 to the age of 65. So who invested more money? No, the brother. $1,000 a year from 35 to 65. So that's 30,000. But at 65, they're only going to have $101,000. That's the power of compounding. So $10,000 invested earlier is worth more than $30,000 when it's delayed more than 10 years, more than 30 years total. Right? So the power of compounding, your money working for you. And this is my favorite illustration. This is someone starting an investment account, starting a retirement account at the age of 25, right? 25, you just graduated from college, you probably got your first job, you're going to save $6,000 a year, so roughly $500 a month. You know, that's a lot of money, but it's not impossible. Maybe you still live with your parents. So you start at 25, and you save $6,000 a year to the age of 65. That at the age of 65, based on a 7% rate of return, you're going to have $1.28 million. $1.28 million. But say at 25, you just graduated, you've been eating oodles of noodles on a college campus for 4 years, you kind of want to live a little, you want to buy a new car, you want to kind of show off. So you say, I'm going to wait. I'm going to wait 10 years. I'm going to wait a decade. So I'm going to start saving at 35. So if you start the savings account for retirement at 35 and you invest $6,000 a year from 35 to 65, at 65, you'll only have $606,000, less than half. Now that's an expensive decade, right? But at 35, you have children, they want to go to Busch Gardens, and they want to play travel soccer. And so you're just like, I can't invest right now, I'm going to wait. So you wait until you're 45. So if you start investing in your retirement at 45 to 65, you're only going to have $261,000. That's an expensive decade also. So this goes to the power of compound, the power of letting your money work for you. And so just to double click on that, the person who started at 25, right? He invested a total of $220,000 over the 40 years, right? That's a pretty significant amount of money. But you had $1 million worth of growth over that same time period. All right, so you put in 220, that's worth 1.28. So when I talk about retirement, there's a couple of retirement accounts, and they really come in two different flavors. The first flavor is called the traditional flavor. So you're able to put in $6,000. If you're above 50, you're able to put in extra $1,000. The money, you get a tax deduction when you put it in. It grows tax-free, and when you take it out in retirement, you have to pay taxes on it, right? And this account is easily to administer. You can open this account with $100 initial investment. It's usually very low cost in terms of having this account, and you have a wider range of investment options. This is called a traditional IRA. The next flavor I call the lemon pepper IRA. It's also known as a Roth IRA. That was a joke. Nobody got it. So the Roth IRA is a little different because it's the same contribution, the $6,000 plus $1,000 catch up if you're over 50. But the money, you don't get a tax deduction when you put it in. It grows tax-free. And then when you take it out in retirement, you don't have to pay taxes on it. Then when you take it out in retirement, you don't have to pay taxes on it. And so it's a very kind of beneficial account. A couple of things about the Roth also. The Roth is, life often happens. So if you have money saved up in your account, you can take out your contributions without any taxes. Like the contribution that you put in, you could take that out at any time because you already paid taxes on it. Additionally, there's 5 reasons where you can take out both the profit after 5 years. You can take out the profit for 5 reasons. If you have major medical expenses or you become disabled, God forbid. If you're buying a home for the first time, you can take out your profit from your Roth with no penalty and no taxes. You can, buying a home, saving for college. So if you're paying for college in anyone in your immediate family, you can use the money from your Roth IRA. And buying a home for the first time, college. If you're early retirement, so at 59 and a half, you can take your money out of the Roth with no taxes. So it's very kind of beneficial. And because they're self-directed, there's a multitude of halal options. In addition to these, there are also employer plans. So if you're a business owner, or if you work somewhere and they have a 401k or 403b, these plans allow you to put away more money than you can in individual retirement accounts. For the 401k, it's up to $20,000 of your money that you can put away for your future. These plans, usually the expenses are paid by the employer, so they're very low cost for employees. And then they also It depends whether or not they have halal options in your 401k. One of the things that we do is that we work with our shareholders to see if their company can offer, some of Islamic options in their 401k plan. And we also offer a 401k plan also for business owners. So, now moving on, we're going to talk about what it means to be an Islamic investment company and how do we kind of screen our stocks. And then we're going to talk about just some of our mutual funds and then give a slight history of them. So we have 3 screenings. The first screening is we look at the primary line of business for the company. So ask yourself, would anybody in here work for Anheuser-Busch? No. Would anybody in here work for Smithfield Pork? So if you want to work there, why would you want your money working there? So if you're investing in something like the S&P 500, you're going to include companies like Smithfield Pork, like Anheuser-Busch, so on and so forth. So the first screening is we look at their primary line of business. If their primary line of business is something against our Sharia, or pornography, alcohol, then we're not going to invest in it, full stop. Number 2, we're actually going to take a deeper dive and look at their financial statements. We're going to look at their balance sheet and say, how much debt do they have? We want to compare that to the value of the company. We're going to look at the type of assets they have. So if cash and accounts receivables are over 45% of their total assets, then we're not going to invest in that company. And the third one is we also look at percentage of revenues from outside sources, from secondary sources that are not permissible. So for example, if a company like Southwest is a transportation company that flies people from point A to point B, but they sell alcohol on their flights. And so we're going to go and do the due diligence to say how much alcohol revenue do they have compared to the total revenue of the company. And so what our scholars have said is that that percentage has to be less than 5%. So for example, for Southwest, it's like 1 to 2%. For most of our companies, they're around 1 to 2%. So we're not trying to get close to that mark. And the third screening is that instead of just looking at our Sharia criteria, we also look at environmental factors. So we also look at ESG, environmental, sustainable, and good governance, because we want to make sure that these companies are also good for the environment and good for the people they're serving. And so we're backing all of that up with a Sharia advisory service. It's a company called Amana Advisors. It's in Malaysia in the Gulf. And so they audit us on a quarterly basis. And then they give us a fatwa on a yearly basis that says they're doing things according with the Sharia, according to how we said we were going to do. And just to talk about our funds, we have 4 mutual funds because there's different investors. There's different needs for each investor. So the one on the bottom is called the Amana Participation Fund. This is the fund that's the most conservative. So it's not an equity fund, so it's not invested in companies. It's actually invested in Islamic fixed asset certificates in the Middle East. And so it's like a bond fund. So it's going to have very low returns, but it's going to be more stable than some of the equity funds. Then going up, and so is the Amana Income Fund. This is looking at large cap US companies who are actually paying a dividend. So these companies are well kind of established so much that they're paying a dividend to their shareholders. The third fund is Amana Growth Fund. The Amana Growth Fund is our largest fund. It's almost around 3 to 4 billion in assets under management. This fund started in 1994. So you can imagine this is almost 30 years of track record of investing according to these principles. And Amana Growth Fund is large US companies that are reinvesting in themselves for further stock price appreciation. And then the last one is Amana Developing World Fund. This is a fund to give our shareholders exposure to the developing world. So the developing world can often have good returns when the US market is kind of stagnant. And so we're going to look at some of those returns for those companies. So in this illustration, it shows if you invested $10,000 in the Amana Income Fund 10 years ago. So in June 2012, if you invested $10,000 in Amana Income Fund, it will be worth $27,000 today. And so to relatively look at that number, if you invested $10,000 in the S&P 500, it'll be worth $33,000 this past June 2022. Right? So over 10 years, it grew from $10,000 to $33,000. If you invested that same $10,000 in the Amana Growth Fund, it'll be worth $36,000 in June 2022. So over that 10 years, it actually outperformed the S&P 500. Looking at the specifics of it, if we look at the track record, this is 1, 3, 5, and 10 years. So looking at 10 years for the Amana Income Fund, the annualized return over the last 10 years was 10.76%, which is pretty solid. The S&P 500 over that same time period, the return was 12.95%. And then for the Amana Growth Fund, that annualized return over the last 10 years was 13.8%. So it actually beat the S&P 500. Looking at the Developing World Fund annualized return over the last 10 years was 1.18%. The Emerging Market Index is our benchmark for the developing world, and that was 3.06. So as an asset class, like developing world funds didn't really perform that well over the last decade. Then our Amana Participation Fund, the annualized return over the last 5 years, because it's not yet 10 years old, was 1.6%. So the participation fund, it's, the target return is around 2 to 3%. So it was a little under our target, but you can see the FTSE Sukuk index was 2.61%. So this is the one that's supposed to be, more conservative. One of the questions that folks ask me is, well, Hood, how do I pick? I want to open an ESA, I want to open an IRA, or I have $20,000 that I want to invest. How do I know from the Amana Growth Fund, the Income Fund, Developing World Fund? And so we have this tool. It's called the Amana Fund Selector. It's on our website. It's free. There's no commitment. It asks you 8 questions. These 8 questions are asking you to understand your risk tolerance, your investment objective, your time horizon, and it gives you a sample allocation of these 4 mutual funds. And then you can choose to use that, you can adjust it, or you can take it over. So that was the last slide. We have some material in the back. And we also have a clipboard that if anybody wants me to reach out to you to talk about investment, or talk about your personal situation one-on-one, then just fill out that clipboard, and I'll reach out through email. We can schedule an appointment. Okay, can you pass that clipboard right there? Can you pass that around? Yeah, and there's also some information sheets in the back too, if anybody wants to learn more information. But I think we got a few minutes for question and answers. Come on. Any questions? Very good question. So the question was, how did you get to that 5% of haram incomes? One of the things is our fund started in 1984, and you can imagine there wasn't a lot in terms of Islamic investing in 1984. And it's a funny story because it started really from the community. So some Muslim families got together and wanted an alternative to putting their money in a checking account and receiving interest. And so they opened a fund with just a couple of families, and they started saying, what are the guidelines we're going to use to invest? And so after the fund kind of initially launched, we went back to scholars. We worked with the Fiqh Council of North America to kind of understand how are we going to screen out these equities. And so they said, show us all the companies that meet these criteria. No haram income, so on and so forth. And there was 2 companies, and both of them were banks, and that's something that we can't invest in. And so they said, okay, they came up with the idea of, the analogy is when you look at a large body of water, if you look at a large lake, if there's najasa in the lake, it doesn't invalidate the whole lake, right? You can still make wudu from it, you can still drink from it if it doesn't change the taste, the smell, so on and so forth. And so they said, what percentage do we want that to be, right? Is that 1%? Is that 7%? Is that 5%? And so the scholars kind of came up with 5% and kind of agreed on 5% because it's not changing the overall makeup of the whole company. And that 5% has to be in a secondary line of business. If it's their main line of business, then it's not going to be permissible. Just to give you an example of that, two examples. One thing is Pepsi. So we used to invest in Pepsi Cola. Pepsi Cola decided to make a hard Mountain Dew. So it's a Mountain Dew with liquor in it. And because their line of business is making a soft drinks or making drinks, because they make an illegal drink, that's a company that we can't invest in. So we often have to make decisions like that in terms of, what companies we will and will not invest in. There's, so there's different standards across the globe. IOFI, what is the accounting and auditing standard for Islamic financial institutions, has one set of standards. Pakistan Supreme Court has another set of standards. Other countries in the Gulf have standards. Malaysia Securities Board has standards. And what you'll see across the board is each one is trying to measure the same thing. So, for example, we look at 33% of debt to the total value of the company using market cap. Other organizations would use debt to total value using their assets of the company. So it's the same thing, but it's different in terms of how you value a company. Oh, I'm not sure. I was just using that as an example. Southwest is not one of the companies we in. Another company was Bed Bath and Beyond, right? So Bed Bath and Beyond is a retail company. Bed is fine, Bath is fine. But what's Beyond about? And so one of the things that Bed Bath and Beyond decided to do was to sell alcohol, right? Because they are a retail company and they sell alcohol. That's something that we won't invest in at all because your main line of business is retail, and part of your retail is alcohol. So that's something that I think we divested from Bed Bath and Beyond. That's a very, very good question. So how does one pay zakat on stocks? And so for our shareholders, we actually will calculate the zakat for you, right? And we'll send you a zakat statement once a year. It says your zakat on this account is X, Y, and Z. And so the zakat methodology that we use, and we had our Sharia board, the Fiqh Council of North America, approve it. It's 10% of the growth, or 10% of the profit. So because these are investable assets, they're out in the market, it's almost like a field. Like you're not going to pay zakat on your whole field. You're not going to take 2.5% of your field. You're going to take the produce from the field and the income or the profit that is created. The income from the profit that is created, you're going to give 10% of that. So we calculate whatever after a full calendar year, we say whatever was the growth in this account, 10% of that is your zakat. And we'll send you a zakat statement, and you can choose how you want to pay it, whether you want to pay it from your own bank account or if you want to sell your assets to pay it. And no, it doesn't have to come directly from the stock. Exactly. Most people just take out their checking account how to pay it. But we make it easy by giving you that. Like, for example, personally, when I think about my zakat, I think about my bank account separately than I think about my investment accounts. So my bank account, I'm calculating using, the 2.5%, 2.57% on a calendar year. And then for my investment account, I'm just waiting till I get the paperwork from Saturn Capital. No, so it's 10% of the profit. Yeah. So on a yearly basis. So then you don't have to pay any zakat on that amount. Yeah, so your money's going up and down. So for example, if you take it this year and the market is down 20%, yeah. So if you had a $1 million in January, you have $800,000 today, right? So you already lost 20% of your value. So there's not going to be a zakat using that calculation. right? And then, there's other calculations. So this is just the one that we use. Mhm, mhm. Yeah. So because that money is in production. Yeah. So that money is production. The money is not just sitting in the bank account waiting for you. That money is actually being produced. Yeah, working for you. So on and so So yeah, so those are different types of calculations. One is the zakat on assets that you're just holding in your bank account, and then there's zakatable assets. But there's different rulings on 401k plans, right? So 401k plans, some people say you can't touch the money. If you touch the money, there's a penalty, so on and so forth. So this is just the one that we use, and we kind of have our scholars who kind of verified it with us, so on and so forth. And that's the one we use to send out statements. Yeah. So that's one of the options. Like, I read from several different scholars. There are options of, you know, a calculation based on that money minus the penalty, so on and so forth. There's calculations for investing. So these are different calculations. What I often tell people is use a calculation that you're comfortable with from someone that you trust, and then be consistent with it. Right? This is not like when you do your taxes at the end of the year and you're saying, okay, file head of household, file jointly, file single, right? Which one pays the least? Like, that's not what we want to do with our zakat. So whatever calculation methodology you want, just be consistent with it. If there's a reason that you're changing it, then change it and be consistent with that. So these are all good questions. How do I compare to Wahid or Saturna? So I'll take the second question. So I work for Saturna Capital. So just to understand, Amana Mutual Fund is a trust that was started by Muslim families. So all the assets are held in the trust, but the trust has no employees. So Amana Mutual Fund hires Saturna Capital to do the portfolio management, the fund administration, so on and so forth. So I technically work for Saturna Capital. Wahid, Wahid is like a friend of me. Like, if you look at Wahid, they have three different plans. Their conservative plan, they invest in our mutual fund, they invest in our participation fund. And, alhamdulillah, I'm glad that this space is growing. I'm glad that we're having more competitors, right? Because I think the more competitors we have is serving that need for this Muslim population to invest and grow. And so I tell people to look at Wahid's returns, look at our returns, uh, see who's getting you the best customer service. Um, excuse me. See who's giving you the best customer service, so on and so forth. One of the things that Wahid is known for is they have an app. So you go on the app and open the account. You can look at your money every day on the app, and that could be good and bad, right? For an environment like this year, if you're looking at your money every day, it could cause depression, right? And especially when you're not going to use the money, right? If you're investing for the long term, I'm 40 something years old. I have until I'm 65. If I'm getting sad because the market is down 20% today, that's not doing me any good. Next year, the market could be up 20%, and I'll be happy, but it's still not my money. Who knows what you call that when the market is up and you have money in it? You know what we call that? No, something like, but it called an unrealized gain. Because you're a gain, right? You bought it for 100, now it's worth 120, but it's unrealized until you what? Until you sell it, right? And so when it's down, it's an unrealized loss. And so there's some reasons why you might not want to look at your app every day, but we are also working on an app. So we want to make sure that we're reaching the customers where they are. So. Definitely, definitely. One of the things that when we get into fiqh of Islamic finance, when I was in Malaysia, we kind of really deal with that, is that you want to find someone you trust, right? Someone you trust, whether it's, you know, scholar from Malaysia, scholar from Saudi Arabia or UK or America or Dallas, so on and so forth. I said Dallas like it's a Muslim country. Um, it's almost it's almost a Muslim country. Um, and so, there's a lot of different opinions. I think the majority of the opinion, when you look at the Supreme Court Justice of Pakistan, we have this. I probably should bring it with me on the road more often. It's a brochure, and I can send it to you if you email it me, called Evaluating Islamic Criteria, that basically shows the criteria we use, and we compare it to Malaysia, to Pakistan, to the Gulf, to IOFI, so on and so forth. And usually that's not really one of the issues that they're having, right? Because if you have that fifth position, you're not even going to get to the point where you're kind of evaluating Islamic criteria in terms of what it means to own. From the standpoint of owning an asset, like you are an owner, when you own Apple stock, you are an owner of Apple, right? You might not have the certificate in your hand the way they did, 50 years ago. You actually had an Apple certificate of ownership. But one of the proof of ownership is that you actually vote. You're actually a shareholder. So when there's a referendum, or if they're talking about doing a stock split or other things that they want a shareholder vote, you're actually going to get a proxy statement to vote on those things. When there's a dividend, you're going to get a dividend because you're a shareholder. But usually, the people have the opinion that it's not ownership, or not even coming and kind of evaluating Islamic criteria. Yeah, another question. Yeah, so that's a great question. He said that in America, most of these countries use interest, and so what the scholars have said is that first they look at what's your main line of business. So if your main line of business is a financial institution, Merrill Lynch, Bank of America, Wells Fargo, your interest is part of your income, and so those companies are not permissible to invest in. So we're not buying any financial companies. One of the reasons you see our income fund doesn't do well as the S&P is because we're missing out on a lot of those dividend paying stocks or financial institutions. But then when you look at companies like, if you look at a company that's serving pizza, right? So Papa John's is going to be a pizza company, you know, uh, and undoubtedly they're going to have cash reserves. So those cash reserves are going to have interest. So that's how you look at where does that 5% come in. So if their interest income is 10% of their total income, then we're not going to invest in it. And so we're looking for companies who are under that 5% threshold. And another thing of that, so it's two other caveats, is that we have a purification calculator on our website. So for folks who want to, if you put in the number of shares and based on the percentage of haram income, they'll tell you the amount that you need to purify. So if you have 100 shares of the income fund, you can put that in and it'll tell you so on and so forth. And yeah, and so those are kind of ways that you have to kind of think about Islamic investing. When you think about companies, like if you go somewhere like Malaysia, there could be companies where they're 100% Islamic. And there's very few companies in the world, right, who are operating in kind of these capital markets that are 100% Islamic. They're not going to have any kind of revenues that's impermissible. But um, that's what the scholars have kind of had to say in order to give Muslims this product that they can use. They kind of had to use um, the qiyas for when you're looking at a bottom of water and how much impurities before it changes the overall makeup. So if a company is like 6% interest income, then we're going to look at that company different, right? For example, if we look at a transportation company, that 60% of their 60% of their income is from alcohol, then they're basically a bar in the sky. They're not an airline company. It's a bar that flies people, so on and so forth. So that's why you have to look at their main line of business, then look at that 5%. These are good questions. Oh, so I think you can do it yearly. So you'll just put in how much shares you have, and you can say you donate. The other point is that the scholars have said that the expense ratio that that each shareholder has to pay in terms of fund kind of negates that you have to purify it. But for some folks, we still have that on there because they want to take that extra step. You had a question, sister? We can talk about that after the class. And so we actually have some pizza here. We're going to get this question. We have some pizza. I'll be around so we can talk one-on-one if you have any questions. But go ahead. Yeah, well, for credit card, if you're paying on time, there's no interest. I'm saying it. Yeah, so when you think about Islamic finance, just like anything, right? If there's going to be a lot of different opinions on halal chicken, whether it's hand slaughtered, machine slaughtered, so on and so forth, there's going to be a lot of opinions in terms of what is and what is not. And so there are two things, is that folks have to have a strong knowledge of the Quran and Sunnah, right? Then they also have to have a strong knowledge of what a credit card is, right? And so oftentimes you have to have both to really give an answer that's going to be kind of relevant to people here. And so also if you find some scholar who has that both and you're comfortable with it, that's the one that you want to kind of just trust and kind of stay with consistently. So does that answer your question too? I know you asked the same thing. No problem, no problem. Mhm. Yeah, definitely. Islamic investment is different than Islamic finance, like guidance, so on and so forth. But I'll tell you this thing: there's not one company that is haphazard. There are some companies, but most of the major companies, nobody's haphazardly just making fatwas, right? And when you look at a Sharia board for many of the Islamic financial institutions, these Sharia scholars are, whether you agree with them or not, you can't argue that they know their subject. They've been studying, for example, if you look at someone like Chief Justice Taqi Usmani, he's been studying Islamic finance longer than I've been alive, right? So for me to go on the internet and do a Google search and say this sheikh said this, that, and he's saying one thing, it's like, this guy's been studying it in detail. And one of the things I say about Islam in America in general is that we're kind of caught in this conundrum um, where, when in Malaysia, I lived in Malaysia for a year when I was studying Islamic finance. There's not like this, oh, I have to be this mini scholar to buy a home, or I have to be a mini scholar to open an investment account. Like they trust their government institutions. That says that government institutions does the work to say, hey, this is halal, this is certified, this restaurant is certified. You can go there, you cannot go there. And they do the same thing for their Islamic financial institutions in Malaysia. They have to be certified by an authority. And so really one of the things that we have, and this is not just in Islamic finance, but this is the kind of broader aspect of Islam in America, is that we don't have that authority. So everyone's trying to recreate it. And so I tell folks that I understand this is a serious issue, but organizations who are doing this work, who are having a Sharia board, who are known scholars, and scholars are going to disagree, right? I was with scholars who would tell us other opinions. Like this is not my opinion, but my coworker says this. So it's an acceptable opinion. And so that's where it really has to be a level of authority and a level of trust because these are institutions. Like at some level, we have to trust our institutions that they're doing their due diligence